Good morning, and thank you for joining us. I'm Chris D'Ambrosio, Head of Australian Corporate Services at OTC Markets. I'm joined today by Jim Burns from Burns & Burns Law Firm, Steve Ellis and John Baker from AST Financial, and Andrew Riley from Baker McKenzie in Sydney. Today we're going to discuss the benefits of cross-trading ASX securities on our marketplace. Before we get started, I'd just like to address a few housekeeping items. All attendees are on mute and will remain on mute throughout the presentation. All Q&A will be addressed at the end of the presentation. If you do have questions, please enter them into the box on the right-hand side of your computer screen. Additionally, all contact information is at the end of the presentation. So our agenda for today will be an overview of OTC markets, a review of Australian law considerations for foreign ordinary shares versus ADRs, a brief description of DTC, and a discussion of the process for cross-trading on OTCQX and OTCQB. So first and foremost, who is OTC markets? Who are we? We are the over-the-counter stock market. We've been in existence for over 100 years and support over 10,000 U.S. and global securities. Which ultimately have a market cap of nearly 15 trillion, which is about 30% larger than NASDAQ. From an international perspective, which is clearly most relevant for our audience today, 70% of all OTC trading volume is in international securities. To take it one step further, from a securities perspective, 70% of all ADRs are level one. All level one ADRs trade on OTC. As we stand right here, right now, we have over 2,300 ADRs that trade across our markets. So this slide here shows how our company is structured. We have three business silos. Market data, which houses all daily trading information, as well as our daily compliance file, which is consumed by the likes of Goldman Sachs, Morgan Stanley, UBS, Deutsche Bank, and all the other largest banks and brokers in the world. OTC Link ATS, Alternative Trading System, which is our broker-dealer-driven trading technology, and all the trading occurs there. And Corporate Services, this is where I reside. It consists of our domestic and international business development teams, our OTCQX and OTCQB relationship management teams, and our advisor relations team. This shows here how we've segmented the overall marketplace, the three market tiers that we've created. Pink is the lowest. There are no barriers to entry. It's an open marketplace, consists of non-reporting, bankrupt, distressed, and non-compliant companies, no minimum financial standards. That's why we created our higher SEC-recognized marketplaces, OTCQB, which is our venture stage market tier. There are pre-revenue companies there, emerging growth companies. In order to maintain an OTCQB quotation, companies must meet a penny bid test and must provide an annual verification and management certification. ASX companies that you might recognize are Zelda Therapeutics, Australian Mines, Fatfish Internet. Those are all currently on OTCQB. And as a matter of fact, we just were joined by another ASX company today, Deep Yellow. And our highest market tier, OTCQX, it has the highest financial eligibility requirements, the highest corporate governance standards. Therefore, it's going to attract the most liquidity, the most broker interest, and most importantly, most investor interest. This is our alternative to an exchange listing, and it's generally viewed as analogous to a NASDAQ or New York Stock Exchange MKT listing. ASX companies that are currently on OTCQX that you might recognize are Fortescue Metals Group, Lumina, Cleantech, Star Pharma, and Bionomics. So the benefits that come with moving up to OTCQX or OTCQB are multifaceted. It's going to allow CEOs, CFOs, and IROs to better promote and market the company, as potential investors will actually have a security that is tradable because the risk parameters have been removed. Thus, the diversity of your shareholder base will increase. And you can't really discount the fact of having a freely tradable security that trades during U.S. market hours and is quoted in USD. especially considering the time zone difference. I suspect conversations with investors will be much easier and effective if they have the ability to trade domestically. So what we've tried to do is make it as easy as possible for foreign companies to tap into the deepest capital pool in the world. So without getting too granular, I'm not a lawyer, I won't get into any legalities, but the SEC has what's called the SEC Rule 12G32B, which states that if a company is listed on a qualified foreign exchange, the ASX is a qualified foreign exchange, that company, if it chooses to cross-trade on OTCQX, does not need to be SEC reporting and does not need to follow Sarbanes-Oxley. So companies will gain all the upside of an exchange listing, the visibility, the tradability, the liquidity, and will gain all that without the duplicative reporting and incremental cost that comes with it. SEC reporting on an annual basis can be anywhere between 500,000 USD to, in some cases, 2 million USD. So to take that significant cost off the table, yet still gain access to the US and North American investor base, that's a tremendous advantage for a foreign company. So we, a few months back, commissioned a third-party study, and these are the results right here. The results actually came back way better than we expected them to. I won't go through each one, but there are a few things worth noting. First, U.S. ownership increases. So when lowering risk barriers and increasing tradability and visibility, we thought this would increase U.S. shareholder base, and this proved that it did, and it did about sevenfold. Another point is that there were significant liquidity increases across the board. Whether it's an F-share or an ADR, people focus on liquidity here in States, but it should be noted that the increases were both in the home market and the OTC market. So not only did moving up not cannibalize home market liquidity, but actually increased it, plus 28% on average, and plus 37% on average on the OTC market. More brokers, more investors, more accessible stock equals more liquidity across the board. So something that's a little different to the U.S. securities market, we have blue sky laws here. Blue sky laws are state regulations that dictate how investment information is disseminated in each individual state. There are about 280,000 registered investment advisors in the U.S. These brokers cannot discuss, provide research, or solicit orders for pink stocks. To address these laws, my legal and compliance team has worked tirelessly, and we now have blue sky exemptions in 27 states for OTCQB and 30 states for OTCQX, which means these 280,000 brokers can now disseminate research, discuss your stock, and solicit orders in many more jurisdictions, which is obviously going to open doors, expand the possible pool of investors who otherwise might not even know about your company. The next two slides are real-world consequences of restrictions on pink securities. So this one here shows that UBS and Credit Suisse, who have some of the larger broker forces here, actively impose restrictions on pink securities and tell their brokers, we will not trade, we will not hold, we will not custody pink securities. So alert your clients to this fact. This slide here is an actual email a broker at one of these houses sent to one of the largest global firms, which has their home market in Europe, and they copied us on it as well. The company was on pink. The broker wasn't able to trade the security despite a $100 billion market cap of the company. To paraphrase the broker's email, you might not be concerned with me as I am just one broker, but what is a very big concern for you are the 5,000 other colleagues of mine that are also in the same predicament with all their clients, which also number in thousands. So this is a significant issue that is very easily rectifiable with move to OTCQX. So there are two pieces to having a successful U.S. footprint: tradability, which I just discussed, and visibility. Obviously, visibility plays a huge role because if investors don't know who you are, they can't invest in your company. You may be a fully reporting and compliant company on your home market, but if you're on pink, you likely can't distribute information here in any kind of efficient way. Pink companies don't have access to these financial portals, and data distributors that you see here on this slide and that we have relationships with. OTCQB and OTCQX companies are able to post financial reports, issue press releases, and otherwise get their story out via these very powerful and highly visible North American portals and distributors. So in the past few weeks, I've actually been asked by a few folks that are with us, that have joined us today, Chris, the company has assets in North America, either in the US or in Canada or both, or we have a very global business in scope that's well understood here. So can my North American investors trade my stock? If it was a pink security, my answer more often than not was no. Well, I included these two screenshots to illustrate the answer changes if the stock is on OTCQB or OTCQX. Interactive Brokers, Fidelity, E-Trade, Schwab, Scottrade, all of these online brokers can trade our higher market tiered securities, and actually some of them are even market makers on our marketplace. So from an information distribution perspective, foreign companies usually find it difficult to get in front of North American investors. If the company is on pink, their information isn't made readily available, so investors who research companies likely see dark screens. Conversely, when investors want to research OTCQB and OTCQX companies, their information will be found on all the main financial sites, Yahoo Finance, Bloomberg, CNN, CNBC. It will be viewable on our website, OTCmarkets.com, which gets over 1.5 million individual visits per month. And the news will be picked up by all the main North American newswires. And perhaps the most important part is when OTCQB and OTCQX companies upload their financials into our OTC portal, we automatically Edgarize those documents. That's the SEC filing format. And that's going to allow investors to perform peer group analysis using financials that are all viewable in the same format. So this is just a visualization of our visibility program. As you can see in the top left, that's a photo of our market center here you can use for investor conferences or meetings while you're in New York. It can be your home away from home. In the top right, that's virtual investor conferences that are available. And obviously, once again, time zone being drastically different, this will allow you to access your global investor base on their time and when it's convenient. Bottom right will show you our publication in our monthly newsletter, which has over 40,000 subscribers. And finally, in the bottom left, CEO interviews. Actually, one of our most recent interviews was given by myself to an ASX company that is on OTCQX, Bionomics, and it was with CEO Dr. Deborah Rathjen. At this point, I'd like to turn it over to Andrew Riley, partner at Baker McKenzie in Sydney.
Thank you, Chris. Hello, everyone. This is Andrew Riley, and maybe I should give just a tiny bit of background because some might be wondering why I'm speaking on both U.S. and Australian law. So I have been living here in Sydney for 20 years now, advising Aussie companies and accessing the U.S. capital markets. To start off, Chris mentioned ADRs, and also that you can have quoted ordinary shares. There's basically the option between ADRs and ordinary shares. And in brief, for those who don't know, ADRs are these American Depository Receipt programs established first about 1950s. And the focus or the design is to enable American investors to invest in foreign companies. And back in the 50s, a lot of countries had restrictions on foreign ownership, exchange controls, other restrictions that inhibited the ability of Americans to own. So what happens is in the home country, the shares are put into a deposit facility, so technically remain in the home country. And then a depository bank then issues what are called ADRs out of New York. And the Americans trade these ADRs, which are governed by New York law, and they trade in the US and US dollars. So in quoting on the OTCQB or the QX, Australian companies have the choice of actually doing the traditional ADRs, or more recently been ordinary shares, which has been becoming more common over the last 10 years or so. So some clients ask, well, which one do I choose? And what's the difference? So this slide and briefly summarizes some of the differences. An ADR program is a slightly easier to establish because there is less documentation. One of the documentation issues, which I think our friends at AST will discuss, is the requirement for the ordinary shares to be eligible for trading through what's called the Depository Trust Company, which is basically a kind of a clearinghouse, similar to Austraclear here in Australia. And for ADR programs, you don't need to do that. It's not required effectively, but for the ordinary shares, a little bit required. And so for the ordinary shares, again, can be a little bit more expensive to establish. For small issuers, for large issuers, the depositories may pay establishment and maintenance cost, but for smaller issuers, they tend not to do that because the depositories make their money on the trading volume of the ADR. So for large issuers with lots of trading volume, the depository banks can make a buck there. And if they can't make a buck, then they do charge maintenance costs to the issuer. Other types of costs can be corporate actions, like a share consolidation is a bit easier to do with ADRs compared to ordinary shares. And for the investors, they actually pay the brokerage cost. So that for them, there's a little bit of cost for using the ordinary shares. The issuer actually pay maintenance costs for OTCQB, and they each have their brokerage costs. The investors have to pay ADR fees, and so depending upon the fee, that might be a little bit more expensive for them. Maybe turning the slide just to look at some of the legal requirements first for the ordinary shares. The main thing is this depository trust company is owned by the big brokerage houses, and it basically has a monopoly position, and you basically need to do what they want to do. Otherwise, you can't have your shares, ordinary shares, quoted. So they do require an indemnification agreement, and over the years it's been developing. When they discovered that Australia has something called a stamp duty that somewhat freaked out DTC. So they do require a indemnification agreement whereby the issuer agrees to indemnify DTC if it becomes liable for any Australian stamp duty. As you probably know, Australia got rid of the stamp duty for shares that are traded on the ASX, so that tends not to be a problem. And then we have to deliver a few different legal opinions, two different legal opinions. One is a Australian legal opinion, basically giving DTC comfort that they can play the role that they do without any breach of Australian law or the company's constitution. And then they require various other legal opinions with respect to the indemnification agreement, customary legal opinions. Maybe we can turn the slide to the last one to talk a little bit about the level 1 ADR programs. As Chris had mentioned, they're the most popular type of popular type of ADR program is the level 1. This is for trading over the counter. The level 2 and 3 involve a listing on a US stock exchange. And again, ADRs, again, negotiable instruments. They're governed by New York law, trade through the US brokerage system. It does enable a company to better play to the US marketplace. As you probably know, in Australia, when a company does an IPO, the share price is typically between $1 and $2, and the US market practice is between $10 and $20 US. So this enables a ratio of typically, say, 10 or 20 per share. So there'd be 1 ADR for every 10 ordinary shares or every 20 ordinary shares. So you can have your shares priced on ASX, say about $1 share, and the US trading about $10 per share. In terms of legal documentation, there's a rather standard deposit agreement between the issuer and the depository, and it gets filed with the SEC on a Form F6 registration statement. The only other requirement is one that Chris had mentioned, this Rule 12G3 exemption, which basically means as long as a foreign company on a recognized stock exchange like ASX has its annual report and other materials publicly available and in English that they give to the stock exchange, then they don't have any reporting requirement with the SEC. The one, I won't say drawback, but one caveat with the ADR program, and it's same with the ordinary shares for any over the trading market, it is for secondary trading only. It's for, again, for investors to buy and sell shares on the market. It may not be used for the raising of new capital by the company. For that, you can do a private placement in the US of ordinary shares, but you can't use it to raise capital. And I think now maybe I'll hand over to John at AST.
Great, thank you.
John?
Samir, thank you. I'm going to add my welcome to everyone as well. So thank you for joining us. In order to go ahead and commence the movement of your securities from the Australian exchange over to the U.S., you will require the services of a U.S. transfer agent. AST is the second largest provider here domestically with 26% of the market share. So, step number one, you would have to go ahead and engage a U.S. transfer agent, and that process typically would take 3 to 5 business days to complete. The second part, which we just were discussing, is in regards to the DTC eligibility process and making your security eligible here in the OTC so that the security is easily tradable broker to broker. That process in partnering with DTC typically takes 4 to 6 weeks in totality, and there's some documentation requirements which we will handhold and walk you through the process. But primarily what we're doing is moving securities off of your exchange over here to the OTC, and in doing that part of that process, we're going to have to go ahead and submit an application to DTC to complete that. That is a 2-page application. Again, it's a fill in the blank. We go ahead and provide you with the template, and we will walk you through that process to go ahead and complete that. Once we receive the application, we'll submit that to DTC along with the applicable information that they're going to be looking for to go ahead and complete the process, which is going to include the opinion that Baker McKenzie was just referencing, and they would go ahead and partner with U.S. counsel to ensure that the opinion meets the requirements of the depository trust company. Once we have the DTC eligibility, DTC requires that a security be deposited with them within 30 days of that eligibility. In order to complete that process, we will go through a transmutation process, which is where you will need to identify an investor in your company, and it would have to be someone that would not be considered an affiliate of the company. So you would have to identify either a person or an entity that has an interest and willingness to move their securities over to the U.S. exchange on the OTC. We'll go ahead, again, provide you with the documentation, the 1-page document to go ahead and be completed. We will go ahead and provide that to DTC, and we will move those securities from the Aussie exchange over to the OTC. And at that point, that security is now trading, and you are now DTC compliant, which means now that we've gone ahead and established that relationship within that 30-day window. Others that have interest in moving the securities and taking advantage of the OTC liquidity will be able to go ahead and do so. And they will continue to partner with AST anytime that movement is going to take place. So we'll go ahead and walk you through the process so that in any event where there's an investor or an entity that approaches you and expresses interest in doing so, they can approach us or they can approach you directly. We'll go ahead and assist them with that process. After that, like I said, the process takes from start to finish approximately 4 to 6 weeks. It'll really be dependent upon DTC's review of the application. So, on average, again, that 4 to 6 week window. And with that, I'm going to go ahead and turn it over to Jim Burns.
Hello, my name is Jim Burns. I'm a lawyer in New York with the law firm of Burns & Burns. We're a firm that deals with securities regulations, securities filings, financing, state blue sky, and all sorts of stuff like that. The process for trading on the OTCQX and QB is a very, very simple process compared to applying, getting listed on the New York Stock Exchange or NASDAQ. It's a walk in the park comparatively. The costs are significantly much less, and the time frame is a fraction. The steps are pretty basic. You need to appoint a QX sponsor to help prepare the QX or QB application submitted to the OTC market groups for the review. The QX sponsor can be either a lawyer, investment bank, a depository bank, and they all have their pros and cons. Obviously, we think the lawyers do the best job for that. The next step is you need to arrange for a United States broker-dealer to file a Form 211 with FINRA, which is the regulatory body overseeing broker-dealers, in which they apply to be the initial market maker for the company's shares in the United States. Then you also then have to pay the application fee when you submit the application, which is, you can see $5,000 US for the QX and $2,500 US for the QB. After the OTC markets will then review the application and the company, and after they approve it, in 10 years we've never had them not approve an application for ones we've been involved with. The company will then have to upload to the OTC site the last 2 years of financial statements, MD&As, annual and quarterly reports, shareholder meeting materials, and other similar documents in the OTCIQ. After the companies begin trading on the OTCQB and QX, they continue to file these same documents as they did with the initial application. When all this is done, then the sponsor will then submit its letter of introduction, in which it certifies to the OTC markets that the company satisfies all the listing and eligibility requirements. For companies applying for the OTCQB, they are required to submit a certification, which covers very basic information regarding the number of round lot shareholders, shares in public flow, who their lawyers are, accountants, investor relations, professionals, shareholdings of the insiders. And finally, the annual fees for the QX, which is $20,000 US, and the QB, which is $12,000 US. The main, like I mentioned earlier, this entire process for companies that are well organized can be completed in a number of weeks, compared to many, many months or even a year for the New York Stock Exchange or NASDAQ listings. The costs are a fraction for the exchange listings. Also, the various steps that I just outlined, doing the application, arranging for the broker-dealer, et cetera, those things can all be done simultaneously. Also, if the company is applying for DTC eligibility, that can also be done simultaneously, and that's what we recommend, that everything be done in parallel. So you don't have to wait till one part is done until you go on to the next part. And other than that, that's it. It's a pretty straightforward, easy process relative to a New York Stock Exchange or NASDAQ listing, and we think it's terrific.
Thank you, Jim. Thank you, John. Thank you, Andrew. So just to wrap things up, I hope we've been able to broadly outline the benefits of cross-trading on OTCQX and OTCQB, how it's far and away the most effective and cost-efficient way for foreign companies to access the North American market in order to gain increased tradability, liquidity, and visibility. So one thing I would like to address, because I have fielded questions on it in the past, is what you see here, NASDAQ International designation. Just to be clear, this is purely a visibility offering. These F shares or level 1 ADRs continue to trade on our market here on the OTC market. We have built our OTCQB and OTCQX visibility offerings to complement the increased tradability of the securities and vice versa. If a company intentions are to get more eyes on the stock and tell their corporate story, a freely tradable and liquid security goes hand in hand with that. OTCQX and OTCQB accomplish both. NASDAQ International designation does not. So here's a sampling of some of our largest OTCQX companies from a global perspective. You'll see Adidas, you'll see Fortescue, Roche, BASF, BNP Paribas. They can have a listing anywhere in the world. They've chosen OTCQX as their entrance to the North American market. From an Australian perspective, you'll recognize all these names as ASX-listed companies that are already here on OTCQX. As some of them I mentioned previously, Illumina, Cleantech, Star Pharma. And finally, some ASX companies that are already on OTCQB, Australian Mines, Samson, Oil and Gas, Zelda Therapeutics. And this is the contact information I promised earlier. We can all be reached at these contact information here. So that concludes today's presentation. At this time, I'd like it to open up to the conversation for Q&A. If you do have any questions, please go down to the right-hand side of your screen. Answer them there. All right, we already have one. So once we begin trading on the OTC markets, is there a contact in your company that can assist us with any problems that may arise? Yes. We have an entire client relationship team for both OTCQB and OTCQX. They're on here. They're on hand to handle any questions that may arise. I sit right next to them. In addition to that, we have an advisor relations department that maintains relationships with all advisors that we deal with, including IR firms, law firms, bankers, and obviously they're always happy to make introductions to a company or firm that best would fulfill your needs. All right, got another one. Do we have to pay the whole annual fee up front? So OTCQX is prorated your first year to the calendar year. OTCQB is the flat fee. On OTCQB, you are billed from the month you joined. So if you joined, July this year, your next bill would be July of next year. On the OTCQ market, like I mentioned, you're prorated first year to the calendar year, but you're billed around mid-October, if I remember correctly. All right, we'll take one more. You mentioned something about dissemination of news through OTC markets. Can you elaborate on that a bit more? Sure. Once you begin trading on OTCQB or OTCQX, you'll receive credentials from our portal, which is OTCIQ. You'll be able to upload all your news up there, all your financials, and it's going to be released on your company's profile that's on our website, OTCmarkets.com. And additionally, actually, I should mention, we recently partnered up with Issuer Direct, which is a PR distribution service that has pretty good distribution across North America. And they also offer services like webcasting, mini IR solutions, and that EDGAR XBRL filings, which I referred to earlier, of preferred pricing for companies on our markets, of course. All right, well, oh, I got one more. Hold on. Looks like we have one more here. No, I don't think anything came through. All right, well, that wraps up our Q&A session. Thank you again for joining OTC Markets. I'd like to thank Jim Burns from Burns & Burns Law Firm. I'd like to thank John Baker from AST and Andrew Riley from Baker McKenzie. The recording of today's webinar will be sent out to participants, all of you that are here. Also, you may download a copy of today's presentation that's located on the right-hand side of the handout section of the Citrix portal. Please don't hesitate to reach out to myself, Jim, Steve, John, or Andrew with any additional questions. Thanks again for joining us.